All right, welcome back to another episode of the Deduction Desk. I'm Joe, Sagar, and today we're going to be speaking about some of your more business owners that are deeper into their actual business. They've owned it for 10 years, 15 years, 20 years, and now we're at the point where we said, look, there's definitely value in this business. It's worth money, and now I'm looking to exit this business and potentially sell it. What are the best ways in order for me to accomplish that? And then also, what are the traps that most people fall into where they don't realize that they're actually losing money by approaching it from that perspective, right? So we're going to cover things like asset versus stock sale, installment sales, QSBS, and why it doesn't always work, charitable strategies, and then really try and focus on mistakes that usually cost people between 6 and 7 figures, depending on how much your business is worth at the time.
Yeah.
Right?
Yeah, I think when we first started the company, we were on the side of the people that were buying stuff just because we were younger, our clients are younger, and now, as we've gotten older, we're starting to see the other side of it, of the exit and getting out of the company.
Right.
One of the things that, just to quickly chat about it, before you even can get out the starting blocks, what kills a deal right away? Number one always is bad books and bad accounting. That is 100% what I like, at least from our standpoint, whether it's going for a mortgage and you're just showing up with a bunch of scraps of paper, or you haven't filed your taxes in 2 years, right? Or you're trying to sell a company and someone starts digging in and they're like, how are you even keeping track of what you're doing?
None of this stuff makes sense.
I can't trust your numbers, then I'm not going to move forward with the deal. That's always one with a bullet of what immediately ends negotiations when you're ready to exit.
Are there companies that, there has to be, right? There's companies that are, you're on your way out 2 years, 3 years before you're going to exit. And you're like, my books are not even close to where they should be. So I'm going to hire someone to make sure that everything looks as clean as possible and caught up. And that could be a regular accounting firm. Is that considered, that's not forensic accounting, right?
That's auditing more,
okay,
right? So really, if I were taking this business and we were trying to bring it to the market, what we would get is a third party to come audit us.
Got it.
Your accountant can't audit you. It's got to be somebody else's accountant that comes and makes sure that everything's correct.
You want them to blow holes in your business, basically, on paper.
Well, not even that. You want them to basically go through your records and say, hey, we as an accounting firm are giving our stamp of approval saying that these numbers are accurate.
Oh, I see.
You can rely on these numbers to do your analysis of this business.
Okay.
It's not forward looking, it's backwards looking, but backwards looking is important.
Yeah. So, so for business owners who are in the first couple of years of setting up their business, right? Save yourself a headache and make sure that you're doing the accounting and all of that stuff correctly, because at the end of the business, you are more than likely going to want to sell it and benefit from the sale of the business. And it's a lot easier when that's done, right?
What else do we see? We see you have one customer who makes up 80% of your revenue. That usually will kill deals.
Kill it, yeah. And he's like 90 years old.
Or the whole thing runs because of one guy, like your CEO, or what? Sometimes not even the CEO. You have like a president of sales or a president of
and they're the reason why
relations.
you have as much going on, right?
And if they left, your business would go down 70, 80%. Like that can also cause an issue. Something that, we just had a long conversation with one of our clients on. They just merged businesses, like these two guys that we worked with, and they have a pretty big footprint, and their goal is to aggressively grow over the next 2-3 years and then sell their business, right? They've gone in with this thought process, which is the ideal way to really go about your tax planning, is knowing when you want to exit and how you're going to get there. And one of the things we discussed was, hey, do we have some room here to maybe write off some things that, maybe you want to write off a car. Maybe you want to pay a company on 1099 instead of W-2 to save on the payroll taxes. Little things like that are aggressive positions that are gray, or you could even make the argument that they're wrong, but a lot of businesses are doing it. We had a very long, hard conversation about it, and we advised them, if your goal is to sell in 3 or 5 years and you're taking these aggressive tax positions, the person who looks at your books, who's looking to buy you, is going to say, if you're not afraid of cheating the government, what makes me afraid of you not trying to cheat me? Right? So you're going to give me wrong numbers. You're going to give me things if you're already lying to the government or you're pushing these aggressive tax positions. So we've seen that many times, and we advise people, one, follow the rules always,
Yeah.
right? But if you are going to sell your business, then go above and beyond.
Yeah.
And maybe
Make
off,
no doubt that you're doing it the right way.
pay an extra $50,000 in taxes if it's going to allow you to sell your business for $50
Without
million,
a headache.
right? So those are the things that usually will stop you before you even start, right? So now the question is like, once you actually get to that position of wanting to sell, right?
Okay.
There's probably two ways to go about it. I think you and I have talked about it,
Yeah.
right? It's like you can either sell the assets or sell the stock of the
Well, and I
company.
think that's like really the first step, right? So even from a negotiating standpoint, I know that I'm going to bring this business to the table.
Yeah.
I got to know what's beneficial for me and what's beneficial for them. And then this way I can leverage the best conversation to get the most out of it.
100%, right? And it's about who knows the most about their taxation,
Right.
and who knows the most about depreciation and recapture and all these things that's going to allow one person to have the edge over the other. Because at the end of the day, as crazy as this sounds, if you're selling me something and I'm buying something from you,
Right.
you and I have two completely different ways of going about this to maximize the benefit for ourselves. A seller is always going to want to sell the stock of their LLC or their corporation or whatever their entity is.
Okay.
And you, as the buyer, are almost always going to want to buy the assets of my business and not touch my stock. All right. And there's a couple different reasons behind it. There's legal reasons behind it.
That's probably number one.
Definitely number one, right? You don't want to take responsibility for the things I've done. There's things from the Supreme Court recently that said there's an unlimited amount of time that they can go back and audit fraudulent returns. So if I committed fraud 20 years ago,
And I buy your company.
yeah,
It's now my problem.
it's now your problem.
Well, so let's say I bought your company and then I sold your company to my own company
Yeah.
afterwards, right? Are they still going to look back and go, well, this was still you?
It's a great question. I think if you did something like that, where you purchased the stock and then sold the assets to another entity,
Right. Sold it to like you started another business and you just sold it to your other business.
I
Like
mean,
someone from
generally-
being the outside who hasn't done this, and you've obviously experienced a lot more, that would have been a question if I'm someone watching saying, all right, well, why don't I just do it that way?
Yeah,
Right.
I mean, I would assume the IRS is going to go after everybody that's involved,
Right.
you and the former owner,
Okay.
and whoever they can get their hands on first is who they're going to take the money
It's more
from.
likely going to be you.
Yeah, and then once you've paid, then you have legal recourse to go back and say, hey, it was in my contract and it said any prior liabilities you're responsible for.
Right.
But now I would have to go after you to go get that money.
Yeah.
Right. So it probably becomes not worth it even.
So making it cleaner, you're not buying the actual company. You're just buying all of the assets that are in the company, and then you let the actual owner who's selling it just dissolve their business.
Yeah. I don't even want to touch your business. I want your goodwill. I want your IP.
Right.
I want your name. I want your assets.
So even the name's not going to have an effect if you still purchase the name but not the actual.
No, because the liability
entity?
sits within the entity that was doing all the work.
So you can still transfer the name over, and even though the name was the company that did the fraudulent stuff 20 years ago, you could still argue that, well, it's not the same company anymore. It's the same
not-
name.
Yeah, it's the
Right.
same name. It's not the same company.
Okay. All right, cool. That makes sense.
So if I were, and depending on who my client is, if you're the buyer, I'm going to say buy the assets. If you're the seller, I'm going to say sell your stock.
Okay, so if I'm the seller now, right? So let's go from the other side. I'm the seller and I'm saying to myself, all right, how do I make this look sexy enough where the buyer's going to say, all right, I'll buy the stock.
Mhm.
That's where you start discounting or...
Yeah, that's part of it, right? It's like, hey, I'll knock $1 million off the price because it's going to save me $1 million more in taxes,
Right.
Or $2 million in taxes.
Well, and so what's the benefit? Let's talk about that. What's the benefit of selling a stock compared to selling assets?
So two aspects to it.
Okay.
All right. The first aspect to it is recapture of depreciation.
All right.
All right. If I have a bunch of equipment that I wrote down to zero because I use bonus depreciation.
Okay.
And
I have
now
3 trucks in a building, wrote them down to 0.
Yeah. And
Okay.
now you come and buy the assets and you buy the building and the trucks for $1 million. And
You got to
I've
recapture
zero.
whatever you purchased. Them.
I have to recapture all of that depreciation to get back to my original cost.
Right.
And then from my cost to what you gave me is capital gain.
Got
Okay.
it.
Capital gain is taxed at a lower rate than recapture of depreciation.
Recapture's higher.
Recapture is
And I'm
taxed
taking
higher.
it on the chin. So if you're the buyer, I'm saying I wrote off majority of my stuff.
Correct.
So you don't want to buy the building because now you're going to pay 25% in recapture compared to 20%. The other.
And if I write you a check for $1 million, I can now turn around the next year and write all those assets back down to zero as the buyer. You paid the tax on it. You sold them to me for $1 million. You recaptured all your depreciation. Now I get to use it the following year. So that $1 million I spent right off the bat, I'm getting somewhere around $300,000 of taxes
by buying the stock.
Well, by buying the assets.
Okay, got it.
As the buyer. So that's the disadvantage for the buyer and the advantage for the seller, basically summed up. You avoid the recapture.
Gotcha.
Right? Whereas if you sold me your stock and your stock is at $0 because you wrote everything down to zero,
right,
and I give you $1 million, you're going to still pay taxes, but you're going to pay capital gain on that $1 million that you gave me. Whereas if me as the buyer, I gave you that $1 million for stock, you can't depreciate stock. So now I don't get any benefit on the write down of selling the stock there. Right? Or buying the stock from you there.
Okay.
So it's completely opposite on each side where the benefit is. The buyer and the sellers are both incentivized to do different things. There's some scenarios where a seller may have an advantage by buying your assets that have already been depreciated.
Right.
One of those is like a QOZ. If you have a QOZ that has a holding period of 10 years before it becomes tax-free, which is like a very real estate niche thing, and you've held this LLC for 5 years, I may want to just buy your stock so I don't have to reset my 10-year holding period. So that's one reason. Another one is maybe you have licenses and permits that are specifically linked to your LLC. Say you're a cannabis business. Say you're a boating business. These are things that have permits and licenses and docs or whatever other thing behind it that's linked specifically with your license. And if I just come and buy your assets, I'd have to reapply for those licenses, right? And then that's a whole issue. So I may just say, all right, I'm fine with not taking the depreciation. I just want this so I can avoid the headache of reapplying for stuff.
Right. Well, but you being the seller, knowing some of those things and knowing that, hey, they've got this, they've got this, they've got this. Hey, here's all the headaches you're going to have if you don't buy the stock.
Exactly. Maybe that's the way you structure it. If you are one of these people in these businesses, that it becomes very sticky to keep the permits and licenses within the LLC.
Right.
Maybe in those cases, you also have your equipment and your assets in there. You took the depreciation and now you don't have to pay the recapture because you're going to sell your stock.
Right.
Instead of doing a separate holding entity just for your permits, which some people do.
Gotcha.
So very in the weeds, very complicated, but I'm hoping we're at least letting you guys know, like.
Well, I think the awareness of it, right?
Like,
you know what? There's a lot more stuff involved in this as opposed to me saying, hey, my business does this per year. I 5X this, this is what I'm going to sell the business for. And now all of a sudden it's like, why am I not getting that check? Or what we're going to get into, why am I getting that check and I got to pay $1.5 million out of the 5 back to the government when I probably could have avoided that if I'd done some of the things we're going to talk about.
Yeah. So now let's get to like, what are some ways just very quickly of avoiding some of this gain?
Yeah.
Right. Let's say you've done your asset sale or your stock sale.
Okay.
Right. What are the savings opportunities? Right.
Sure.
One of the best ones is an installment sale.
Okay.
Let's say Joe can't get qualified for a mortgage for $5 million for my piece of property that I own.
Right.
But he sees the vision of it being a $20 million property in the future.
Right.
And I have the best buyer I can find is Joe because nobody else sees what Joe's seeing. Right. What I might be incentivized to do is give him seller financing. Okay. And I may say, all right, put down $1 million today on this $5 million and then pay me the other $4 million over the next 10 years. If you just do that, pure seller financing, that additional $4 million
doesn't get taxed at the same time.
No, it is taxed because I've sold the asset for $5 million.
Got it.
But if you do structure it as an installment sale, which is a specific type of contract that the government allows you to do, then I only pay that remaining tax on that $4 million as you pay me.
So over 10 years, you're dragging it out so the percentage is going to be lower. So
and you're keeping yourself in a lower tax bracket.
Right.
Instead of like taking a bunch of income in one shot and having the highest tax bracket possible, you're also spreading out the tax bracket. So that's a very,
sounds
very
like
critical.
How most of the time it probably goes. No, I mean, how many buyers are walking up with
I've seen
$10 million
so
check?
many people
Really?
that
Just
have
one
done seller financing and have ended up having to pay for everything. And when you get a mortgage, it's not seller financing.
Right.
Right? You can get a mortgage, your bank.
So there's a lot of risk as the seller with the finance. Because if you say, well, give me $1 million, you see my property being a $20 million property in the future. I don't know how, but great, let's see you do it. And then 5 years down the road, you're like, I can't do it.
I'm walking away, yeah.
Right, like you were right, this property's not worth anything.
Well, then I foreclose on you because I'm holding the note on you.
Okay.
So I foreclose on you and get the property back.
Right.
So
and sell to somebody else.
And then do it again. So that's one way of handling an asset sale to avoid all of the tax consequences right away.
Got it.
Right? You do an installment sale. Now on a stock sale, something that exists that's amazing. And if you are able to actually do it, fantastic.
Right.
I don't see it happening a lot because of this issue between companies not wanting to buy people's direct LLCs.
Right.
And that's QSBS, Qualified Small Business Stock. There's a couple of criteria to it, right? I think it had to be set up under $10 million basis. It's a C corporation and you've had it between 3 and 5 years. It starts to taper down.
Got it.
If you hold your C corp like this and I sell you my stock, then I don't pay any capital gain on up to the first $10 million of profit.
So why wouldn't everybody do that?
Because we go back to you probably don't want to buy my
actual stock. So when we talk about stock sale, right? This QSBS is what? Like just how you file the taxes on the sale of the actual business?
It's it's how you pick up when you file your tax return, you say that this was qualified small business stock. I set it up meeting all the correct criteria. I held the stock for 5 years. And
so as long as you held it for 5 or longer.
Yeah.
Okay. So now I'm 10 years into the business, or let's say I'm 10 years into the business and I know in the next 5 years, I'm going to want to sell this company. Maybe it makes sense to switch to a C Corp, knowing that there may be potential for someone to buy the stock because maybe there's not a lot of depreciated assets.
Yeah. Or maybe we want to bring in partners in the future. Right. And you're like, hey, I want to bring in 2 or 3 guys that are going to help me run the business. And at that point, you're not going to make a new company. They're just going to step into the business.
Right. So now you
can sell your stock then.
Yeah.
And you avoid the taxes on it.
Oh, that's smart.
So these are, once again, how often do we see people buying actual stock? It happens institutionally. Maybe if you're selling to a company that's already running its own business and they don't want to have a separate entity, they just want to buy you out and merge you into their company.
Right.
That happens. Or somebody you've worked with for many years. Or if you have really solid books that get audited every year and you're like a full-fledged corporation that's operating very professionally, then we see it happening.
So is it up to 10 million? There's
there's a whole calculation for it. It's like what you started the business with and then what you sell it for, what your basis was, and then you can't have started it.
So it's the lesser of the two, right? So it's just a $10 million cap no matter what you do. Yeah. It's going to have a calculation based on what your actual business, what you purchased or what you
It's not the value is $10 million. If I put in 20 million and I sell it for 30, I still avoid that $10 million.
Right.
So, and then look, we can get into even more complicated strategy. I think it's overkill at this point.
Yeah. People are sleeping halfway through this thing already.
Shouldn't be. This is how you save some
especially
money.
if you're in the future you want to sell the business. I think to both of our standpoint, that's an actual reality in the future where there are sellable points. This is really creative ways in order for you to make sure you're prepared.
If you give us 5 years to get you ready for a sale, I think we can save you a significant amount of money.
Yeah, and there's the plug, right? Start talking to us now, so within the next 5 years we could do all the planning we need to make sure you sell it properly.
Exactly. I mean, that's really it, right? We don't need there's reorganizations you can do. There's charitable trusts you can set up. There's gifting of stock when your basis is low. There's tricks that are there.
Right.
But I think step number 1 is determining your time frame and sticking to a time frame.
Yeah. So recap, number 1, we want to make sure we have an idea of when we're going to sell this business and what the time frame is. Number 2, we want to make sure from an accounting standpoint, if a third-party accounting group came in and they audited your books, they would look at it and go, this looks pretty good. I'm going to put my check of approval on there. And then number 3, making sure that as you're approaching the market and who you're going to be selling to, that you want to understand what's the best approach from a negotiation standpoint, because we as the sellers want to to make sure that we sell stock if possible.
Yeah.
And the buyer's always going to want to sell the assets. So finding that middle ground.
Great point that you brought up. Just like the last thing to throw in there. This applies to things like real estate too. If you're buying something and you're like, hey, I'm buying this just because it's a good rental property, it's a flip, don't take accelerated depreciation. Don't get a cost segregation. Don't write the thing down to zero. You're just going to pay the taxes back in the future.
Yeah.
Right.
I think in general, unless you know you're passing away soon, maybe at some point you're going to pay the taxes to some degree, right? If you're depreciating it, you're going to sell it,
correct,
right? So you're going to have to pay the depreciation back. If you save on the taxes now, you're going to have to pay the taxes later if you're putting it into retirement. So it's just about being smart about when you're paying your taxes.
Exactly.
I think that's the
most of it's
the biggest message.
Most of it's deferring it.
Well, and then that's, most of the time. And then you have conversations with clients now that are like, all right, I'm ready to retire. And you're like, okay, well, you have a huge tax bill because you've been deferring for the last 15 or 20 years. And now every dollar that's here, you have to pay tax on if you want to use it for what you plan on using it for.
Right.
So, again, it kind of all comes full circle. I feel like every show we do that there's a message that's ingrained in there, which is don't break the law, obviously. And you're always going to pay taxes to some extent. It's just about being smart about when you're paying it. Some years you have huge income levels. Some years you have lower. So you want to make sure that you're constantly having conversations.
The best you could do is defer it until you die.
Right.
That's the best strategy.
Yeah. Well, and then there's legacy, right? So
and even
I
then,
make
it's
sure
not
I
a
pass
happy
it on to
ending.
my kids, right? Because then the deferral goes to my kids, and then it's their problem.
You get stepped up.
Well, you can step up, right? Yeah. Next show, we'll dive into that a little bit more.
How to die.
How to die efficiently. All right, guys. Thank you again. Look forward to seeing you on our next show. Appreciate it.
Thank you.